On 5th, 6th and 7th April 2021 and deliberated on current and evolving macroeconomic and financial developments, both domestic and global. The MPC voted unanimously to leave the policy repo rate unchanged at 4%. It also unanimously decided to continue with the accommodative stance as long as necessary to sustain growth on a durable basis and continue to mitigate the impact of COVID-19 on the economy while ensuring that inflation remains within the target going forward. The marginal standing facility, that is MSF rate and bank rate, remain unchanged at 4.2%. The reverse repo rate stands unchanged at 3.35%. Let me start by laying out briefly the MPC's decision and its underlying rationale. Since the last meeting, headline inflation, after moderating close to target rate in January 21, firmed up to 5% in February 21, primarily due to an adverse base effect. Looking ahead, the evolving CPI inflation trajectory is likely to be subjected to both upside and downside pressures. The bumper food grain production in 2021 should result in softening of cereal prices going forward. Mitigation of price pressures on key food items such as protein-based components and edible oils would also depend on supply-side measures and easing of international prices. The MPC noted that underlying inflation pressures emanate from high international commodity prices and logistics costs. The softening in crude prices seen in recent weeks, if it sustains, can assuage input cost pressures. The National Statistics Office (NSO) in its update on February 26, 2021, placed the contraction in real GDP at 8% for 2021. Prospects for 21-22 have strengthened with the progress of the vaccination program. The recent surge in infections has, however, imparted greater uncertainty to the outlook and needs to be closely watched, especially as localized and regional lockdowns could dampen the recent improvement in demand conditions and delay the return of normalcy. Against this backdrop, the MPC judged that the monetary policy should remain accommodative to support and nurture the recovery. In other words, the stance of monetary policy will remain accommodative till the prospects of sustained recovery are well secured, while closely monitoring the evolving outlook for inflation. Let me now provide an assessment of the growth and inflation position and the outlook. Let me focus first on growth. Global growth is gradually recovering from the slowdown, but it remains uneven across countries and is supported by ongoing vaccination drives, sustained accommodative monetary policies, and further sizable fiscal stimulus. World output is projected by the OECD to reach its pre-pandemic level by mid-2021. Though it will be largely contingent on the pace of vaccine distribution and its efficacy against emerging variants of the virus. Stronger external demand should support India's exports and investment demand. In the domestic economy, the focus must now be on containing the spread of the virus as well as on economic revival, that is, consolidating the gains achieved so far and sustaining the impulses of growth in the new financial year 21-22. A key aspect of this strategy will be to strengthen the bedrock of macroeconomic stability that has anchored India's revival from the pandemic. This will help stakeholders in taking efficient spending decisions over longer horizons, thereby improving the investment climate. Public investment in key infrastructure sectors is a force multiplier with historically proven ability to revive the broader economy by directly enhancing the capital stock and productivity, and by attracting private investment. The focus of the Union Budget 21-22 on investment-led measures with increased allocations for capital expenditure, the expanded PLI scheme, The rising capacity utilization from 63.3% in Q2 of 2021 to 66.6% in Q3 of 2021 will reinforce the progress and the process of economic revival. In fact, firms engaged in manufacturing, services, infrastructure sector polled by the Reserve Bank in March 21 are optimistic about the pickup in demand and expansion of business activity into the financial year 21-22. Juxtaposition of high-frequency lead and coincident indicators reveals that economic activity is normalizing in spite of the surge in infections. Rural demand remains buoyant and record agricultural production in 2021 bodes well for its resilience. Urban demand has gained traction and should get fillip with the ongoing vaccination drive. The recent surge in COVID-19 infections, however, adds uncertainty to the domestic growth outlook amidst tightening of restrictions by some state governments. In India, we are now better prepared to meet the challenges posed by this resurgence of infections. Fiscal and monetary authorities stand ready to act in coordinated manner to limit its spillovers to the economy at large and contain its fallout on the ongoing process of recovery. There is concern around rising cases of infections, but as Martin Luther King Jr. had said, and I quote, "We must accept finite disappointment, but never lose infinite hope." The increase in international commodity prices since February policy and recurrence of global financial market volatility, like the bout experienced in late February, accentuates the downside risks. The upside risks, however, come from number one, the vaccination programs being speeded up and increasingly extended to wider segments of the population. Second, the gradual release of pent-up demand. And third, the investment enhancing and growth supportive reform measures taken by the government. Taking these factors into consideration, the projection of real GDP growth for 2021-22 is retained at 10.5%, consisting of 26.2% in Q1, 8.3% in Q2, 5.4% in Q3, and 6.2% in Q4 of 21-22. Let me now focus on inflation. While headline inflation at 5% in February 21 remains within the tolerance band, some underlying constituents are testing the upper tolerance level. Going forward, the food inflation trajectory will critically depend on the temporal and spatial progress of southwest monsoon in its 2021 season. Second, some respite from the incidence of domestic taxes on petroleum products through coordinated action by center and states could provide relief on top of the recent easing of international crude prices. Third, a combination of international commodity prices and logistics costs may push up input price pressures across manufacturing and services. Taking into consideration all these factors, the projection for CPI inflation has been revised to 5% in Q4 of 2021, 5.2% in Q1 21-22, 5.2% also in Q2 of 21-22, 4.4% in Q3, and 5.1% in Q4, with risks broadly balanced. On March 31st, 2021, the government retained the inflation target at 4%, with the lower and upper tolerance levels of 2% and 6% respectively for the next 5 years, that is from April 21 to March 2026. An inflation rate of 4% over the medium term has now been successfully entrenched in the economic landscape. The experience with efficaciously maintaining price stability and the gains in credibility for monetary policy since the beginning of the inflation targeting framework in 2016 are reinforced by retention of the target and the tolerance band. From the time after the MPC was constituted in September 2016, Average CPI inflation for the period October 2016 to February 2020, prior to the onset of COVID-19 pandemic, was 3.8%, down from average 7.3% during January 2012 to September 2016. Our research suggests that trend inflation has moderated during the flexible inflation targeting period to around 4% in the recent times. The experience during COVID-19 pandemic period has testified to the flexibility of the framework to respond to sharp growth inflation trade-offs and extreme supply-side shocks over the course of the business cycle. Monetary policy over the next 5 years would aim at consolidating and building upon the credibility gains of the first 5 years of inflation targeting, that is flexible inflation targeting. Let me now proceed and provide some guidance with regard to the liquidity position. In my statements over the past few policy announcements, I have been reiterating the Reserve Bank's commitment to ensuring ample liquidity, ample system liquidity in consonance with the accommodative stance of the MPC. When I say ample liquidity, I mean a level of liquidity that would keep the system surplus, even after meeting the requirements of all financial market segments and productive sectors of the economy. From that perspective, our endeavor has been to conduct liquidity management operations conducive for promoting orderly market conditions. This approach has yielded results. It has facilitated the successful completion of central and state government borrowing programs of close to 22 lakh crore at record low costs with elongated maturity during 2021. It has also facilitated significant amount of private borrowing through corporate bonds, commercial papers and debentures. It would be worthwhile to note that despite the recommencement of the 14-day variable rate reverse repo, that is VRRR auctions since January 15, liquidity absorbed through the fixed rate reverse repo has steadily increased from fortnightly average of rupees 4.3 lakh crore during January 16 to 29 to 4.9 lakh crore during January 30 to March 31st, 2021. Reflecting the surplus liquidity, reserve money has risen by 14.2% as on March 26 year on year, driven by currency demand, while money supply, that is M3, grew by 11.8% as on March 26, with bank credit growth at 5.6%. In view of the success of VRRR and given the rising levels of surplus liquidity, it has now been decided to conduct VRRR, that is variable rate reverse repo auctions of longer maturity as indicated in the revised liquidity management framework announced on February 6 last year. The amount and tenor of these auctions will be decided based on the evolving liquidity and financial conditions. This is a part of the liquidity management operations of the Reserve Bank of India, and it should not be read as liquidity tightening. I hope it is sufficiently clear and explicit, and nothing can be more explicit than that. In fact, by paying a higher rate of interest on liquidity absorptions through VRRR auctions, the RBI is indirectly expanding liquidity, and this is a point which needs to be kept in mind. Since mid-February this year, global financial markets have increasingly turned volatile, driven by a surge in sovereign bond yields over inflation concerns stemming from the edging up of international commodity prices as well as expectations of stronger growth. Bond market volatility and strengthening of the US dollar spilled over to the emerging markets. Expectations of a reflationary cycle in the United States led to a retrenchment of portfolio flows to emerging market economies, which continued through the month of March. Given the strong interconnectedness and strong interconnectedness of financial markets across borders, and progressive integration into global financial cycle, there was an upsurge of investor unease in India, despite repeated assurances and forward guidance on liquidity given by the Reserve Bank. Taking note of the market's discomfort and in consonance with our commitment to ensure ample liquidity and orderly market conditions, the Reserve Bank scaled up its open market operations, OMOs, in February and conducted 5 special OMOs, that is Operation Twists, in February and March. Reserve Bank also increased the amount for the Operation Twist auction on March 4th from 10,000 crore to rupees 15,000 crore. Reserve Bank also adopted an innovative asymmetrical special OMO, that is purchase of 20,000 crore and sale of rupees 15,000 crore on March 10, 2021 to reinforce the compression of term premia as well as to inject liquidity, which drew a favorable market response. These were clear signals that the Reserve Bank will support the market with adequate liquidity through the various instruments in its toolkit. The liquidity impact of OMOs could be gauged from the fact that we made net outright purchases amounting to rupees 3.13 lakh crore during 2020-21. For the year 21-22, drawing on experience, we have decided to put in place what is termed as a secondary market GSEC acquisition program. I repeat, a secondary market GSEC acquisition program, or GSAP 1.0, to give it a distinct character. Under the program, the Reserve Bank will commit upfront to a specific amount of open market purchases of government securities with a view to enabling a stable and orderly evolution of the yield curve amidst comfortable liquidity conditions. The endeavor will be to ensure congenial financial conditions for the recovery to gain traction. For Q1 of 21-22, therefore, it has been decided to announce a GSAP of rupees 1 lakh crore. The first purchase of government securities for an aggregate amount of rupees 25,000 crore under GSAP 1.0 will be conducted on April 15, 2021. The positive externalities of GSAP 1.0 operations need to be seen in the context of those segments of the financial markets that rely on GSEC yield curve as a pricing benchmark. In addition, the extension of held to maturity dispensation opens up space for investments of more than rupees 4 lakh crore. We will also continue to deploy our regular operations under the LAF, longer term repo, reverse repo auctions, forex operations and open market operations, including special OMOs, to ensure liquidity conditions evolve in consonance with the stance of the monetary policy and financial conditions are supportive of all stakeholders. While laying out the liquidity management strategy for 21-22, let me unequivocally state that the Reserve Bank's endeavor is to ensure orderly evolution of the yield curve, governed by fundamentals as distinct from any specific level thereof. Our objective is to eschew volatility in the GSEC market in view of its central role in the pricing of other financial market instruments across the term structure and issuers, both in the public and private sectors. This is a necessary prerequisite for nascent and hesitant recovery to firm up and become more durable. Needless to add, two-way movements in bond yields consistent with the fundamentals are quite normal from a market perspective. However, such movements should not be abrupt and disruptive if financial stability has to be preserved. The Reserve Bank will of course continue to do whatever it takes to preserve financial stability and to insulate domestic financial markets from global spillovers and the consequent volatility. I would urge market participants to take heed of our actions, communication and signals in a balanced manner. Together, we can overcome the challenges and lay the foundations for a durable recovery beyond the pandemic. Let us prepare for our tryst with our potential firmly. Let me now announce some additional measures. Against this backdrop, and with a view to nurture the recovery, certain additional measures are being announced. The details of the measures are set out in the Statement on Developmental and Regulatory Policies, which is the Part B of the Monetary Policy Statement. As you would have noticed over the last 1 year or so, the announcements made under Part B of the MPC statement, which are outside the remit of the Monetary Policy Committee, have had significant role in enabling us as an economy to deal with the challenges emerging from the pandemic. We have also been able to undertake certain major reform measures and certain major policy. We have also announced certain policy decisions which have facilitated the creation of a better ecosystem for our economy to function, not only in the context of the pandemic, but even otherwise. The announcements are as follows. The first announcement relates to TLTRO on-tap scheme extension of deadline. With a view to increasing the focus of liquidity measures on revival of activity in specific sectors, the TLTRO on-tap scheme announced on October 9, 2020, which was made available up to March 31st, 2021, is now being further extended by a period of 6 months, that is up to September 30, 2021. Next announcement relates to liquidity facility for all India financial institutions. Special refinance facilities of rupees 75,000 crore were provided to all India financial institutions like NABARD, SIDBI, NHB and Exim Bank during April to August 2020. To nurture the still nascent growth impulses, it is felt necessary to support continued flow of credit to the real economy. Accordingly, liquidity support of rupees 50,000 crores for fresh lending during 2021 will be provided to all India financial institutions, and this will consist of rupees 25,000 crore to NABARD, rupees 10,000 crore to National Housing Bank, and rupees 15,000 crore to SIDBI. The next announcement relates to enhancement of limit of maximum balance for payment banks. With a view to furthering the financial inclusion and to expand the ability of payment banks to cater to the growing needs of their customers, the current limit on maximum end-of-day balance of rupees 1 lakh per individual customer is being increased to rupees 2 lakh with immediate effect. Next announcement relates to ARCs, asset reconstruction companies. Asset reconstruction companies, that is ARCs, play an important role in the resolution of stressed assets. Their potential, however, is yet to be fully realized. It is therefore proposed to constitute a committee to undertake a comprehensive review of the working of ARCs and recommend measures to enable these entities to meet the growing requirements of the financial sector. Next relates to permitting banks to on-lend through NBFCs. Recognizing the key role played by NBFCs in making credit available to the last mile, bank lending to registered NBFCs other than MFIs for on-lending to agriculture, MSME and housing was permitted to be classified as priority sector lending. This dispensation, which was available from 13th August 2019 till March 31, 2021, is being further extended for another 6 months up to September 30, 2021. Next announcement relates to enhancement of loan limit against negotiable warehouse receipts. With a view to encouraging farm credit to individual farmers against pledge hypothecation of agricultural produce, it has been decided to enhance the loan limit under priority sector lending from rupees 50 lakh to rupees 75 lakh per borrower against pledge or hypothecation of agricultural produce backed by negotiable warehouse receipts as well as electronic negotiable warehouse receipts issued by warehouses registered with the Warehousing Development and Regulatory Authority. Other warehouse receipts For other warehouse receipts, the loan limit for classification under PSL will continue to be rupees 50 lakh per borrower. Financial Inclusion Index. Financial inclusion has been a thrust area for the government, the Reserve Bank and other regulators, with significant progress made under this approach over the years. To measure the extent of financial inclusion in the country, the Reserve Bank proposes to construct and publish a Financial Inclusion Index, FI index, based on multiple parameters. This will be published in July every year for the financial year ending previous March. Next, I turn to centralized payment systems, that is we are extending the facility, membership under centralized payment systems, that is RTGS and NEFT, to entities other than banks. Let me elaborate. Membership to the RBI operated centralized payment systems, that is RTGS and NEFT, is currently limited to banks with a few exceptions. It is now proposed to enable non-bank payment system operators like prepaid payment instruments, that is PPI issuers, card networks, white label ATM operators and trades platforms regulated by the Reserve Bank to take direct membership in RTGS and NEFT. This facility is expected to minimize settlement risk in the financial system and enhance the reach of digital financial services to all user segments. We are also announcing interoperability of PPIs and increase in the account limit to 2 lakhs. Let me elaborate. The Reserve Bank had issued guidelines in October 2018 for adoption of interoperability on voluntary basis for full KYC prepaid payment instruments. As migration towards interoperability has not been significant, it is now proposed to make interoperability mandatory for full KYC PPIs and for all payment acceptance infrastructure. To incentivize migration of PPIs to full KYC, it is proposed to increase the current outstanding balance in such PPIs from rupees 1 lakh to rupees 2 lakh. Detailed circular on this will be issued separately, and we will provide adequate time for the entire process of transition to happen. Next, cash withdrawal from full KYC PPIs issued by non-banks. At present, cash withdrawal is allowed only for full KYC prepaid payment instruments, that is PPIs issued by banks. As a confidence boosting measure and to bring uniformity across PPI issuers, it is now proposed to allow cash withdrawals for full KYC PPIs of non-bank PPI users.